Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, 𝗘𝗀𝗓, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, 𝗘𝗀𝗓𝗢.
Welcome in, 𝗘𝗀𝗓𝗢 here with Real Estate Radio Live. I hope everyone is doing well. Hope this podcast finds you well. Thank you again for those that all continue to tune into the show. Very exciting to announce, again, we're back up to thousands, several thousand of downloads each month. We hope to continue to grow that and get the show back to where it was. And we took a little bit of a hiatus. We're back now doing one at least once a week. So thank you again, all those that follow the show, download the show, share the show. Appreciate it. Also continue to get a lot of emails and texts during the week for questions about financing, what's happening in the marketplace. Odd market for sure. I've done a few different shows now talking about how much we're focused on the interest rates. I think we're hyper focused on the interest rates, and we shouldn't be. You should be focused more on opportunity and timing versus interest rates, because that's really the main thing to do. So today we are going to talk about DSCR loans. DSCR loans, which means debt service coverage ratio loans. And so I'm going to try to simplify these. These are super exciting loans specifically for purchases of investment properties. And the exciting parts about it, I'm going to break them down, is that you don't have to qualify the building. I shouldn't say the building. The property qualifies for the loan. Basically, the person doesn't. So it's a whole different component to financing. Super exciting. You're getting people that are buying hundreds and hundreds of and thousands of these properties with these financings throughout the United States. And it's really about the property. So in a quick sense, I'm going to go through more details, but it's really difficult to get these kind of loans, if not impossible, in most areas of California, just because the numbers don't work. The numbers have to work on the property, which means the property, unlike, very similar to commercial, if you're familiar with a commercial loan, the way they finance commercial loans is basically the rent rolls. What is the property getting for rents? What's the liability? What's the loan amount? What's the coverages? What are the things that take place? And what is the ratios on this property? So like the DSCR loans are very similar in that it's about the property than the person. So we're going to go through that. Again, DSCR loans, we're going to go through them in detail. I'm going to try to simplify it and keep it as common sense as I can, because a lot of people that talk about these loans, they get way too complicated. They dig into the weeds and go way too deep, and they kind of discourage people and turn them off in the sense of making it sound like it's super difficult. Like anything, you have to educate yourself. You have to gather a lot of information, do your due diligence. But these are great loans. So I'm going to talk a little bit about them. If you're looking to buy properties outside of California, these are great programs, great options to use these loans. So keep that in your mind, and we're going to go through them. So again, DSCR, debt service coverage ratio loan. So they're based on the cash flow of the rental property and the loan payment. That's basically the way it works. There's no tax or personal income documents that's needed on these types of projects or these types of loans. They're much easier to qualify for than the traditional mortgages, and it covers all rental properties. So any kind of rental properties, and you can build your rental portfolio much faster this way when you're buying properties like this, because you can move them quicker. There's less, if you get the right property, there's less down payment, faster closing times. There's no income or job verification required. The great part about them too, if you own these properties and you want to access cash, you get unlimited cash out. It's amazing. These are great loans. So take a look at as little as 15% down on down payments. That's right. There's interest-only loans that are available. Now, it depends on the criteria of the building and some other factors, but they are available. Both long and short-term rentals are eligible, and there's no maximum number of properties. So you could buy 10, 15, 20, 30 of these, and and be on your way to building cash flow and wealth in your real estate business. So why would you use this versus a regular loan? Well, let's say you're looking at a regular, let's do real quickly, take a look at a regular purchase as an investment property. Let's say you're buying an investment property for $400,000. Typically, you would have to put at least 25% down in traditional financing to get a decent rate. And rates are up a little bit, of course. So 25% down, right? So you're putting this money down, 100,000 basically or so, on this property for your down payment. And qualifying, unlike a DSCR loan, you're qualifying on your personal income and the rent. You're qualifying on the rents as well. Don't get me wrong. So when you buy a traditional investment property, you're giving them your W-2s, your tax returns, your pay stubs, your income statements, all the things you're doing, whether you're self-employed or not. You're giving them all the information based on your income, because part of your qualifying factors is going to be your income. Now, you can use rents, but I can tell you that with the way the lenders do it, they use 75% of the rents. Just that's what they use for their formula. So if you're getting $2,000 a month for rents, a lender, when they're looking to finance this property for you, is only going to give you 75% credit for that rent. So you're not getting the full 2,000. That's the formula that they use. And then so based on the rents, you also then have to show income to prove that you qualify for this property. But there's no doubt that the rents definitely help. So that is kind of a traditional way you buy a property. You have to give them all your income and assets, documentation, basically what we call is a full documentation loan in our business. Now, let's talk about the DSCR loan versus what we just talked about. So let's say you have the same property for $400,000. You can put as little as 15% down. Most people put 20% down. So you have less money down to begin with. Okay, so there's benefit number one, less money down. Benefit number two, you don't have to provide any income or tax documentation. It's all about the property. Now, you might have to put a little bit more down on the property depending on how those numbers shape out, right? So you have to be careful of that. You have to understand those. So you have the second benefit, you don't have the tax and income documentation that typically a person has to do when you're buying traditional property. They're much easier to qualify for. They just are, because it's the building or the property and not you. So there's not more than one factor involved. Easier to deal with than traditional mortgages, and it covers all types of the rental properties again. And building a portfolio quicker, you could do that as quickly as you want, as many of these places as you buy, which is super exciting about that. So any lenders that you work with today are going to have access to these DSCR loans. Okay, so don't worry about, are they limited? Should I go to a certain lender? Should I go to, no, I have them. We do them here in our financing on a regular basis. So again, as we go through this podcast and show, I always remind everyone, my business is residential financing. I also have a network of real estate agents, financial planners, CPAs, anybody you need that could help in your real estate needs. We're here for you. The way to reach me is 408-838-9060. That's 408-838-9060. Or you could always email joe@𝗓𝗡radiolive.com. That's joe@𝗓𝗓radiolive.com. And we could help you with these DSCR loans. These are great, great loans. You're probably hearing a lot about them. I would encourage you to do a little research. They're easy to understand. They really are. And I think the great part about these loans is that they are easy to understand. And they're a lot easier to understand than traditional mortgages. That's why people are starting to use these. The rule of thumb to really be careful about, though, is because it's on the property, the debt service, right? What it stands for when we talked to you right from the beginning, we talked to you a little bit about debt service coverage ratio. So really, it's all about, what is the loan on that building? What kind of rents are you collecting? So what is the cost and liability of that building versus what the rents you're collecting? There's a formula that's used, and it's real simple. And the fact is, it's simpler than traditional financing on investment property, like we told you before, where there's a bunch of factors that go in, including your personal income that gets involved. And that is not the case for these loans. So do yourself a favor, do some research on it, the DSCR loans, and give us a call. We're happy to help you run some numbers. We're helping people with these loans on a regular basis. I will tell you that they're going to be more popular outside of California in cost of living areas that are a little different than what we are here. You know, the DSCR loans are probably going to be in the 3, 4, 500,000 range, maybe a little more, depending on, again, it really depends on what the numbers are of the property. Just keep that in mind. It depends on what the numbers of the property. So if you want to call me and we could run through some numbers, we could real quickly tell you whether you qualify for this loan or not, or the building or the property qualifies for it or not. That is really the exciting thing about these loans. So I wanted to give you a brief overview of those loans. They're simple, they're easy to understand, they're easy to finance. It is a great product that not a lot of people talk about. You're going to be hearing more and more about them. So feel free to give me a call, check in. Just as a quick summary too, as we close out today's quick podcast about the DSCR loans, I want to remind everybody, try not to get so focused on the rate. Make your priority timing and opportunity. Okay? Timing and opportunity equals success. If you base your success or base your timing and opportunity on rates, it would be difficult to make any kind of progress in building real estate wealth. Opportunity and timing. If the opportunity is there and the timing's there, it doesn't matter what the rate is because you could always refinance the rate later on when rates come down. Please don't get hung up on the interest rates. I've been saying this for a few months now. And I know some people automatically go, Joe, are you kidding me? 7.5%? Just 3 or 4 years ago, they were 3%. I know. I get that. But guess what? Everybody else is in the same boat you are, right? So you're no different. Everybody's in the same boat. So this is what I would say to you. While the majority of people are paralyzed because they're worried about the interest rates and they're not focused on timing and opportunity, those people that are focused more on timing and opportunity and ignore the interest rates, those are the people that are going to thrive and win in the long run. Because if you buy a property right now and you pay 7.5% for a great property, right? It's a great property. What is the difference long term? Now, this is what I'm going to say. This is the key word, ladies and gentlemen. What is the difference long term if you buy that building or that property right now for 7.5% today versus 3.5% 3 years from now? Someone will say, well, Joe, I'd rather wait 3 years and buy it at a rate of 3.5%. Really? So let me give you an example. What if you looked at timing and opportunity and you bought the property today for $500,000 and you had a 7.5% interest rate? Okay. Let's fast forward 3 years. And now the same property is on the market. The market is in a frenzy because rates are back down to 3.5% to 4%, and more people are flooding the market to buy, interested, the supply and demand issue. And now you pay $700,000 or $750,000 for the same property at 3.5%. Who did better? Who did better? Think about it. Who did better in this example 3 years ago at 7.5% at 500,000 versus someone that waited 3 years and got the interest rate at 3.5% and they paid 750,000? Who did better? I could tell you who did better. The person who paid 250,000 less with a higher interest rate. That's who did better. Look at timing and opportunity and act on that. Don't simply act on interest rate alone, because then you'll paralyze yourself and you'll always be waiting for the rates to come down. I could tell you, I've interviewed hundreds of people that have invested in properties over the years, and they will all tell you the same thing. Their wealth is made when markets are the roughest. It's not made when rates are 2.5%, 3%. No. You know when their wealth is made? When over years they're buying properties, restructuring properties, and then when rates drop, certainly everybody takes advantage of those and refinances their properties into lower interest rates. Absolutely. That's what we all want to do. But we can't wait, or we shouldn't wait, I should say, when those timings happen. So right now is a great time to buy. And someone would say, Joe, well, you said that 3 months ago or a year ago. That's right. And guess what? If you go back and listen to my podcast, I will tell you right now is a great time to buy. Just like 5 years ago, I would have told you right now is a great time to buy. if the opportunity and the timing is right for you. Do you get where I'm going here? It is always a good time to buy depending on timing and opportunity for you as an individual. Don't base it on someone else. Don't base it on a neighbor, a friend, a coworker. Base it on what your strategy is and the thought process you put together, the due diligence that you do, and the decisions you make to buy a property. Long term, remember those words. Long term, if you take a long term approach, and someone might say, what's long term? Well, I would say 7 to 10 years minimum, right? I would say long term, 7 to 10 years minimum. I would say 10 years would be a long term approach on property because there's the cycles there in 7 to 10 years. So before we wrap things up today, quick review. DSCR loans, great loans for investment properties. Don't lose sight of these loans. Give me a call. Let's talk about it. We get you approved right away. We get the property approved and you get an idea how many properties you could buy. DSCR loans. Give me a call, 408-838-9060, 408-838-9060. Email joe@𝗟𝗡𝗙live.com. That's joe@𝗟𝗡𝗙live.com. Give me a call, check in if there's anything we can do for you. And remember, it's timing and opportunity, not interest rates. If we could help you run scenarios, and if you need any referrals, you need a real estate agent to help you buy a house, sell a house, financial planners, CPAs, anybody you need. We have a great network of vetted professionals here that we work with. So, all right. I hope everyone enjoyed the podcast. Be sure to share it with friends, neighbors, coworkers. And thank you again. We continue to appreciate the support that all of you give our podcast and our show and sharing it with others as well. So thanks again for checking in today. Make it a great day. Until next time, take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit 𝗟𝗡𝗙𝗪live.com. That's 𝗟𝗡RadioLive.com. Subscribe to our podcast. Discover more at 𝗟𝗡RadioLive.com.